From the beautiful Finger Lakes region of upstate New York, this is the Dental Lighthouse Podcast. We take questions from anyone in the dental profession and discuss what it takes to win not only in dentistry, but in life. Business, leadership, relationships, parenting, health and wellness, money management, nothing is off limits on the Dental Lighthouse Podcast. I'm Jason Tenori, your host, and have over 20 years of experience to pull from. Learn from my mistakes and let me help you collapse time so you can become the best version of yourself. Yo, what is up? Dr. Jason here, Dental Lighthouse Podcast. I am in the truck, so I apologize if the audio isn't to your liking, but I can assure you the content will be. Actually, I don't mean to be overly confident about that, but hopefully the content is worth your while, no matter where you're at in your stage of practice ownership or leadership or what have you. So I don't really have any... word I'm looking for. I don't have any agenda for this podcast as much as I'm just going to kind of do some rambling about some things that have really been relevant during my one-on-one coaching. And it's really two things kind of combined into one. It's looking at cash flow analyses from practices, one doctor, one location, 5 doctors in 8 locations, and making sure that we're truly dialed in with what's on each line item. And then that kind of segues into a prospective partnership conversation I've been having with a number of our one-on-one clients about expectations for the incoming partner. So let's start with the single doctor one location practice, just to make sure that we're all kind of on the same page. You have really 3 responsibilities as a business owner, right? So you are a clinician as a single location business owner. And it becomes a little bit more complicated as we grow, but just bear with me. So you are a clinician. Most of you guys, if not all of you guys, are primarily paid as clinicians, meaning that if you looked at everything that you make from an income perspective, a gross majority, I would guess well over half, is based on your ability to produce dentistry. The other remaining income for most of you, the way you have things set up, is as a practice owner or realizing profitability and distributions as owning a practice. Just like some of you guys may own a restaurant that you're probably not the chef in. Some of you guys may own bars that you're probably not the bartender in. Some of you guys probably own Tesla, Apple, and Google that you obviously don't play an integral part in the inner workings of the day-to-day. You receive income from those assets via being a quote-unquote silent business owner, so to speak. So again, most of you are realizing your income through your own hands as a clinician, and then a little bit of income as a business owner. The other thing that you don't really realize as an entrepreneur that you're doing, that you're not typically compensating yourself for, or I would suggest 99% of you are not compensating yourself for this, is being CEO. And when you're in a one doctor, one location practice, you're trying to grow this thing, or you're not, there's a lot of responsibilities that fall under the CEO. The CEO wears many, many hats. You typically wear the HR hat. You might wear the operations hat. You wear the IT hat. You wear the marketing hat. Maybe you have an office manager that can take on some of those responsibilities. But at the end of the day, how it plays out 95% of the time is you're at the chair 4 to 5 days a week. So you're getting compensated as a clinician. And then either at night, in the morning, on Fridays, on Saturdays, you're doing all of your CEO responsibilities, which typically most of you guys are not taking compensation for. And we'll talk about that here in a second. So that's how it ultimately plays out. Now, when we look at a cash flow analysis, I really want you to, and let me preface this by saying, I understand what your accountant's saying. I understand what your banker's saying. I understand what your lawyer is saying. You can really talk about two sets of books here, because you really need to know how well you're doing. So in our coaching group, we have a cash flow analysis. It's super easy to use, super easy to generate, and it gives you clarity on where the money's going. It obviously gives you clarity on where the dental supply budgets are, where the lab budgets are, where the office supply budgets are, how much I'm paying my assistants, how much I'm paying my hygienist. That's, fairly black and white. But what it really gives you clarity on is, what are you making as a provider, right? As a clinician, giving yourself fair market rates of, say, 30 to 35% of adjusted production or collections, whatever's common in your market. So what are you making as a provider? And what are you making as a business owner? How much money is left after you pay yourself as a provider? And what's left from a profitability perspective? Now, our goal for a practice that's not actively scaling is about 20%. So you pay yourself as a clinician, 30% of your collections, 30% of your adjusted production. And ideally, you have 20% profit left over after you've paid yourself as a clinician. Now, with that profit, it's not just all the years. You can't just take all that cash and shove it under a mattress. You need to pay taxes. You need to pay debt. You need to, in my world, you need to ultimately put some money away in an ER fund or a CapEx fund or something like that. But those are the two buckets that you really need to consider. I'm starting to see inquiries from prospective coaching clients where they want me to look at their numbers. I take a P&L from, say, the first half of the year. I ask them to clean it up a little bit. I run it through my cash flow analysis tool, and I see that they're not paying themselves as an associate. They're not paying themselves as a provider, I should say, because their accountant told them to take like a $200,000 W-2 to optimize retirement funds and optimize tax strategies. Again, I get all that, but what they don't realize is the cash left is not nearly enough to cover a provider that would be doing the same job as that. So said another way, with the amount of dentistry they're producing, they would make more money if they were an associate working for someone else than a clinician in their own practice. And that lesson hits really, really hard once you understand the numbers. And unfortunately, a lot of you guys don't even understand the numbers. So you're working excessively hard for an income that is lower than what you would make as an associate with your skill set, all other things being equal, producing the same amount of dentistry. And I'm not trying to guilt you. I'm not trying to judge you. But what I'm saying is, when you don't realize this is occurring, you just keep grinding. And then one day you're like, man, I'm so busy, but there's no money left in the bank account. What is going on here? My accountant says I'm doing great. Our collections are good. Everything else is out of control, including not delegating enough money to pay you as a clinician, not to mention as a CEO or as a business owner. So the first part of this kind of rambling, musing, whatever you want to call it, is I understand how P&Ls are important, but P&Ls don't tell the whole picture from a moment-to-moment basis. You really need to fill out an accurate cash flow analysis so you know where every dollar is going in real time. We're not talking about appreciation. We're not talking about interest expense, like real stuff here, right? Am I being paid what I deserve as a clinician? Am I being paid what I deserve as a business owner? Am I being paid what I deserve for my CEO responsibilities? The 15 to 20 hours, if not more, that I'm putting in beyond my time as a chair, but beyond my 3.5, 4.5, 5 days a week at the chair. So that's the first part of this. You really need to get that dialed in. And like I said, I have a tool. Be more than happy to send it to you. The other part of this, more so, that's been unpacked in my conversations with coaching clients that are starting to scale, right? maybe bring on a partner, maybe they have like 3 or 4 doctors, what have you, is they are doing a certain amount of things from a clinician perspective. Most of these doctors are in a situation where they're working, let's say 3 days a week because they have a couple associates. So they are taking on a lot from a CEO perspective. It could be they're the chief clinical officer and they're mentoring and calibrating everyone in the back office. It could be they're doing everything with payroll and QuickBooks. So they're also the director of finances or the controller. It could be any number of those things. Or what we're also finding is their spouses or their significant others are playing an active role in the company, either head of operations, maybe they're the office manager, maybe they're the director of finance, maybe they're doing all of those things. But that person is not getting compensated beyond what their accountant is telling them to do. So they're making the minimum, let's call it, I don't even know what it is, $25,000 to $30,000, just enough to fully fund their 401k and pay their payroll taxes. But to replace that spouse as the office manager, as the director of finance, as whatever that person's doing, you would probably need a let's say a $50,000 to $75,000 position. To replace you as CEO, you would need a $100,000 to $200,000 position. So I get that when you own 100% of the company, you're not terribly concerned with that. Although I do think you should know what the numbers are telling you via a second set of books or via cash flow analysis. But here's where it gets really uncomfortable. Yo, I'm back. If you're watching this via video, you can see that I'm in a different outfit, still in my truck. Anyways, I was rambling earlier today, and then there was something on the road. I pulled over, tried to help somebody. One thing led to another. And here we are 6 hours later. So if you don't pick up on the fact that there was a part 1 and part 2 all in this same video, then that is a huge shout out to our editor, Steve. But you probably will pick up on the fact that there's a little bit of a nuance between the first half of this podcast and the second half. All right, so real quick, let's review. So we talked about, the prototypical 1 doctor, 1 office, the doctor's at the chair 4 days a week, how he really needs to understand what his compensation would be as a provider, 30 to 35% of collections or adjusted production. How many hours per week is he dedicating towards CEO time, payroll, HR, IT, marketing, all the things that entrepreneurs have to do. Ideally, you put a dollar amount on that. A rough figure is $1,000 a day. Again, I'm not suggesting that you have to pay yourself through a W-2 to do this, but I just think you need to have absolute clarity with where your money's going and where it should be going and what it would cost if you were to replace yourself from a CEO perspective, from an associate perspective. And then towards the end of the morning version of this recording, we started to talk about, well, what about your spouse or even like an older child who takes on legitimate responsibilities within the organization? Maybe it's as an office manager, maybe it's as operations, maybe it's as kind of like a controller, bookkeeper, director of finance type role. And they're on payroll, but they're probably only on payroll for an amount that covers their retirement contributions and the ability to pay taxes. So I forget the exact number, but let's say it's 25 grand. So this has come up a lot with with a lot of my one-on-one coaching clients that are in the process of scaling, in the process of bringing on a partner. So what this situation looks like is you have a founder, owner doc. He might have 1 or 2 associates. And maybe because of those 1 or 2 associates, he's gone from 4 to 4.5 days a week clinical to 3 days a week clinical. And now instead of being a CEO a half day a week, he's a CEO and everything, all the other hats that are associated with CEO 2 days a week, right? And that could be clinical director, it could be CEO, he might also be in charge of of HR, of IT, all those things, right? And then he's got a spouse that is maybe the office manager, or maybe the operations person, or maybe the finance person, stuff like that. So he's most likely not paying himself at all as a CEO, and he is most likely paying his spouse or his older child that is doing these things at a really high responsible level, the minimum to fully fund the retirement and the taxes, right? So now we start talking about entertaining a partner. Now, this conversation is not about the responsibilities associated with the incoming partner. Much longer, nuanced conversation, and completely irrelevant, to be quite honest with you, with what we're talking about here. What I want to make sure you guys understand that are in this position, that are having preliminary conversations with associates that are thinking about buying in 10, 15, 20, 25, a third of the practice, is how was the practice valued? Because if you did it strictly on EBITDA and a multiple of EBITDA, then you're actually making out because you were not getting properly compensated for your position as CEO. You may have not even been getting properly compensated for your ability or your hat as a clinician. And you probably didn't do an add back for the compensation for your spouse, your oldest kid, that's legitimately helping you with a responsibility, with a position that you'd have to pay another person fair market wage. You're just paying them the minimum to cover their retirement thing. So that's the first thing. Valuation was probably off, unless you had someone that knows what they're doing, helping you out. But the other thing that you guys are not thinking about, at least that my coaching clients brought up that I had to kind of coach them with, is post-partnership, right? These people, let's just call it the founding doc as the CEO, working 2 days a week in that CEO position, 3 days a week as a clinician. And let's just call it, to keep it simple, the founder's spouse, who, let's say it's the office manager, right? Who's a phenomenal office manager, does a really, really good job. But we're only paying this office manager $25,000 a week because that what's fully funds the retirement and the payroll compensation. There's a big delta there, right? There's a big discrepancy. And unless we have a transparent conversation with the incoming partner on what you should be getting paid as a CEO working those 2 days a week, and what your office manager slash spouse should be getting paid if you are going to replace him or her in that position, and what fair market value is, now we got a really big discrepancy. On the CEO side, it's usually about $1,000 a day. And on the office manager side, let's depending on your demographic, let's say it's 75 grand a year, right? So where does that money go? Where does it come from? Like, this is something that you really have to figure out. Now, I'm not an accountant and I'm not a tax strategist, so I'm not suggesting that you W-2 yourself as a CEO at $1,000 a day and you all of a sudden ramp up your spouse's compensation to $75,000 a year, because that's what fair market value is of those two positions. But you need to be thinking along those lines. I personally wouldn't do it from a W-2 perspective, but I would definitely do it from some type of language in owner's distributions, or what we'll call below the line expenses. So I really want you to think about this, because if you're not having this conversation proactively with your prospective partner, then they're going to start asking questions about why you're taking additional income for a job that is assumed that you're doing for free, and why your significant other, older child, what have you, is all of a sudden taking additional income, fair market value, but additional in the eyes of looking at it compared to history of what they were getting paid. Because the prospective partner, or now current partner, if they don't know any better, they're thinking that those dollars are profit that they should be enjoying, for lack of a better term, or experiencing as well. So really hope that makes sense. It's a nuanced part of the conversation that really never comes up, and I want to make sure that you don't have to walk it back after the fact, that you have that conversation proactively, and then you decide how best to make it fair from your responsibilities as a CEO, compensation-wise, and from your spouse's responsibilities as, again, in this case, let's just call it office manager, but it could be any number of positions. Figure that out, and don't just keep quiet about it, and then don't have it come up later on, and now you have to kind of walk it back and you have to explain yourself. So just really want to be clear about that. All right, cool. So again, sorry about the break in the recording today, but life happens. Someone's on the side of the road. I was trying to be a good Samaritan and help them, and one thing led to another, and here we are. So again, reach out if you have any questions or concerns about what we're talking about today. My contact information is on the website, dentallighthouse.com, and I hope to talk to you guys soon. Love you. Later.
Thank you. That wraps up another episode of the Dental Lighthouse Podcast. You have a choice today. Choose to be a lighthouse. Lighthouses are powerful and steadfast. They are beacons of light for others to reference when life gets turbulent. Go out into the world today and become a lighthouse for someone. Give more than you get. True joy comes from serving others. Start today. I'm Jason Tenori, your host. Thank you for listening to the Dental Lighthouse Podcast. For more information, podcast show notes, or links to anything that we have discussed today, please check out our website, thedentallighthouse.com. We would love to hear from you. If you would like to get on the show, please email us at podcast@thedentallighthouse.com.